Jim, I'm going to actually keep my mouth closed. And from this point, it is all you, sir.
I'm Jim Vaughn, as Ramesh said. VCapital is our company. Our current portfolio was founded in 2016. That said, the team has been investing in venture capital for a long period of time. My senior partner, Len Batterson, has been investing in venture since, 1981. We have been together for 15 years, but this current portfolio has been in existence since 2016. We are focused, the team is 6 people, investment analysts and back office people and myself. We have an advisory board of 6 people on top of that. These are well-seasoned corporate execs, institutional investors, and some people that really add some benefit in the way of connections and to other investors and can support our companies. One of the biggest things that we like to stress is that we're giving the companies that we invest in much more than just a check. We can help them get to the finish line and grow and sell their companies over time. And having a really dedicated advisory board is a big part of that. I like to say that we are a small firm with a big footprint. We have connections after being in the business so long. Like I said, Len's been around for 40 years or so. I was with William Blair and Company, investment bank in Chicago, for 12 years prior to joining Len. And we've got many connections with other venture capital firms, universities, accelerators, all kinds of things. In fact, my partner, Ryan Cole, began what's called the Midwest Venture Capital Consortium. So this was a group of other venture capitalists, most of whom like to concentrate on deals in the middle of the country. We really like Midwest-based firms, and I will say that we often joke that our definition of the Midwest is anything east of Sacramento and west of Philadelphia. So it's a pretty broad-based kind of geographic, but we like the Midwestern kind of roll-up-your-sleeves work ethic. And frankly, deals are far, far cheaper in the Midwest than they are on either coast. We'll look at similar deals, similar technology, similar teams. If the deal's on the coast, it's 3 times as expensive as it is here. And that's one of our main tenets is what the valuation of the company is. So hopefully I can give you a little insight as to how we do business, how we look at venture capital, and it will give you a little better view of possibly investing, whether it's with us or someone else. So our firm is organized around individual investors rather than institutions. We have a rather unique structure. We don't have a fund. It's individual deal by deal. Most of our competitors have funds. In fact, most of our competitors in venture capital are large organizations that cater to institutions. Some of them have raised hundreds of millions of dollars. And in some cases, I just read about one with NEA, they just raised a $3 billion fund. Now, there's some pluses and minuses to go along with that, but we're unique. We have 450 individuals, families, and small family offices that have invested with us in one or more of our deals. And our mission is to make institutional quality deals that are highly vetted and sorted, available to individual investors at reasonable fees and minimums. Venture capital as an asset class is often viewed as very, very risky. And oftentimes that's correct. It can be very risky. However, there are studies that have shown for a long period of time that venture capital returns can be superior to equity markets. And that's true, but I like to kind of discount a lot of those charts because they're made over 30-year periods. And what they're measuring is large institutional funds like the ones I just mentioned to you. Those guys are putting $50, $100 million chunks to work at a time. And that's fine. It's great for them. But they're waiting until the last stages of companies' growth cycles. And the valuations are very, very high. and individual investors have no way to access those. You just don't have any access to those types of funds. A Kleiner Perkins, an NEA, Sequoia, some of the big deals of venture-backed companies that you've heard of, Twitter, Uber, all of them, Facebook, you just don't get access to those unless you have millions and millions of dollars. Most of our investors don't. They're run-of-the-mill ordinary investors, and they would like to be involved in venture, but A, they don't know how to go about it. B, they don't have access to really great deals. So that's really where we come in as the provider, and providing due diligence and sorting out needles in mountainous haystacks to try and come up with some good ideas. So access is really the key, and it's often very limited. So the reasons to consider venture, as I said, there's high potential returns if you're lucky and you know what you're doing. There's also low correlation with overall markets, and anymore, if you follow the markets, and most of you probably do, if you're on this call, S&P and most large cap stocks seem to run kind of neck and neck with each other, and lots of times people are looking for alternatives to that don't behave hand in hand with the markets. So the other benefit to investing in venture, and this goes kind of beyond the investment returns, is being involved with kind of cutting edge technologies. And I often pinch myself when I get up in the morning, because we get to view many, many deals, and we're involved in the most cutting edge technologies that are out there. Things like quantum computing, drugs for cancer, high-speed analytics, all kinds of things that are just really, really interesting. Nuclear fusion. I mean, it's really amazing the types of things that you see out there, and a lot of them have a lot of good to do for society. And so a lot of the deals we do are delivering much more than just returns to our investors, and we really like being involved in that. So we take a very targeted approach. Most venture firms, or individuals even that invest in venture, take a highly diversified approach because the washout rate is so high. Wall Street Journal did a study, oh gosh, it's several years old now, but they did a study a number of years ago that charted venture-backed companies over a 30-year period. And they found that only 16% of them delivered any money back to their original investors. That's any money, not gains. So if you've got 84, 85% of these things are going to go in that wastebasket over there, that can be highly volatile. And if you're not in the right ones, you can get creamed pretty fast. So most people take a very, very diversified approach. And by doing that, we feel that's not the best way to go about it, at least for us and our particular investors. When you do that, yes, you lower the risk, but you also are very much limiting the potential returns. Institutional investment consultants that counsel large investors are very happy with 12 to 15% returns for institutional customers, right? But they're later stage venture deals, and their emphasis is on turning those investments over fairly quickly. They're not really positioned to wait 8 to 10 years to get to an exit like we are. And I will say our approach takes patience. It takes longer to get to the finish line, but if you do it correctly and you find the right investment opportunities, you can really, really make out with solid returns. So we take a very targeted approach. We only do 1 or 2 deals a year. And we think that's a much better way of going about it. We will look at anywhere from 12 to 1,500 deals a year, our little 6-person team. Most of those we can winnow out very quickly because they don't fit for one reason or another. It doesn't mean they're not a great investment for somebody. They just don't happen to fit for us. And mostly it's because the growth potential is not there that we see over a period of 5 to 10 years. So we can sift that down fairly quickly over the year to about 100 that we think warrant a much closer look. And then we'll drive that down to about 20 that we go really deep on. So out of 1,500, we go down to 20, and we'll do anywhere from 6 to 9 months worth of homework. And when I say homework, we are meeting with the team, contacting all the executives involved, meeting with customers, seeking out subject matter experts, because oftentimes the technologies are way beyond our pay grades. And we're generalists, so we don't focus on one area of the market or another. So we'll look at just about anything. But more often than not, the deals that we end up investing in fall into one of two categories. They're either information technology of some sort, whether it's quantum computing or analytics or data storage, things like that, or healthcare. And in healthcare, we do both pharmaceuticals and medical device, more device than excuse me, than pharmaceuticals, but we're invested in both. That's just where we find the best deals. It doesn't happen to be that we have any expertise, but every time we do a deal like this, we have to recruit subject matter experts who really know these things cold. And we get them very, very involved. Sometimes we put them on a board. Sometimes we will pay them. It just depends on how deep we need to go and at what level we need to understand these deals. But it requires a tremendous amount of homework. So that's kind of how we get involved there. Because of the way we go about it, we're involved in companies on the very, very early stages of their growth cycle. These are companies that are just getting off the ground. They're either seed deals or they're what's called Series A. So it's the first money in after the founders and friends and family. And this is where you can negotiate some really, really attractive terms. Those companies are desperate for cash. There's a lot of seed money out there. There's not nearly as much Series A money. There's lots of later stage money, but the area that we play in, there's a tremendous need for capital. There's a huge amount of deals, like I said, and there's only a small amount of really great deals that we see that we think fit and will be attractive enough to our investors to warrant moving forward. So it takes us some time. It's a very patient approach, but at the end of the day, our returns have been very solid. I would say out of the $50 million in assets under management that we currently have, we're spread out over 14 investments that we've made in the 7.5, almost 8 years now. About 25% of our clients utilize retirement accounts to invest in these deals. And this popped up as a kind of random question one day from one of my investors very early on when we were just getting started. And he said, geez, Jim, I would love to invest, but I just reinvested in my company. My wife just divorced me, so I got cut in half. The only pool of capital I have is my IRA. And I got a lot of money in that. It's sitting in some mutual fund that hasn't performed at all. Can you take IRA money? And I didn't know, frankly. And through our investigation and our homework, we found a couple of custodians, and IRA Club, is our latest relationship that we're just building. And we found that sure enough, we can do this. There's lots of money involved in it. We think there's some advantages. So I would say about 25% of our clients now take advantage of that. And we're happy to be involved. As far as advantages of allocating IRA funds, more often than not, it's just a pool of capital that people have access to. It's tax attractive, right? And I would caution everybody, I'm not a tax expert, and I would advise you to consult your tax expert before you really consider this. But the gains can be sheltered from current income tax. And in a Roth, of course, the gains can be exempt forever. And I know a lot of our investors are converting to Roths and utilizing that type of an approach. So it's an opportunity for higher returns. It's diversification, in particular with alternatives, and there's not oftentimes a lot of opportunities to include alternatives in an IRA. And lots of times, some of our investors are a little bit older, and they say to me, geez, Jim, why would I invest in venture? I'm 72 years old or whatever. And oftentimes we start talking about it and they say, well, I get it. I'm investing this for my kids or my grandkids. So it's a platform to help you, transition intergenerational wealth. So you get your kids involved, and it's really kind of pleasant for a lot of people to do that way. We talked a little bit about challenges of investing in venture. Access is the biggest thing. How to do due diligence on a deal. I've had many people bring us individual deals that we have or they've been approached and asked us to look at it and see if it was a good idea. We do that quite often for people, for our investors. And usually there's some things that they have or haven't taken into account that would be something to consider. So I think the best thing to do is to partner with some organizations that are really expert in this. You can get creamed pretty easily, and usually we hear of deals that my brother-in-law is involved in a restaurant or a deal of some sort, and what do you think? And usually there's a lot more to it, and the structure and the valuation are things to consider that most people don't consider. So we talked about the barriers to entry. VCapital, we really do have what I consider to be access to high quality deals. We've generated relationships with a number of venture firms. This venture capital consortium that we work with, we share deal flow, we share ideas, we see trends. They have experts in their network and their spheres that can help us vet deals. They're also sometimes a source of capital for our deals. We invest in each other's deals from time to time, and it really helps provide support for our investor or for our entrepreneurs as well. Some of them have geographical focus, and so they may be specialists in the Southeast on a particular deal, or expertise in a certain asset or sector, like healthcare, or one thing or another. So we really get involved in that, and we oftentimes recruit people from those relationships to help our entrepreneurs. We are really involved with our entrepreneurs, I wouldn't say on a day-to-day basis. We're not micromanaging their companies, but we are not interested in investing with an entrepreneur that says, give me a check and call me back in 10 years and I'll tell you if you won. That is not a case. We are oftentimes board observers. Sometimes we'll be on the board, but we want to know what's going on, and we view it as a partnership. And unless they view it that way, we're not willing to invest and get together with them. So I would say right now, our current portfolio, we have $50 million under management. It's spread over 14 investments plus investment in our firm. 4 of those investments have exited at a loss. We don't like losses, but they typically will happen before the winners win, and we're used to that, and our investors expect that. 2 others are kind of treading water, and I would say they're there. I'm not sure how much they're going to return, but 8 of them are doing remarkably well. And as I gave you context in the beginning, 8 out of 14 is extraordinarily large number of companies that are well along the growth curve. They're poised for spectacular returns in the next 24 to 48 months. And one of the things I like is with these companies that have lost, 2 of them were zeros, which is typically what happens in our business. And 2 of them returned about 65% of our money. Now, I don't like losses at all, but if I can get 65% back on the duds, I'm really happy. So and the other thing is all 6 of these ones that have either lost or are kind of treading water, those are our smallest positions in the portfolio. Our largest investment amounts are centered on our best performers. And we're able to do that because we don't give them all the money in one chunk. We will typically raise anywhere from, when we have a new investment, anywhere from $3 to $5 million in those initial tranches. And as the companies utilize that cash and grow, they're also courting other investors, and we help them a great deal access other sources of capital. We don't like to be the Lone Ranger. We'll recruit other venture firms or high net worth families to invest alongside us. It's good for confirming what we see, and it's also knowing that down the road they're going to need more money, and we don't like to be their only source of capital. So we like to have other sources of capital there so they don't run out of money. So we'll put $3 to $5 million in our first tranche. They'll come back typically in a B round or a C round, sometimes more than that, for additional capital. And we will participate in those follow-on rounds, provided they're really doing well. And we do extreme due diligence on each one of these rounds. We go back to the drawing board and make sure they're meeting their milestones and they're still progressing towards exit before we will invest another dime. So,
Jim, I didn't mean to cut you off.
no,
So
please.
we have a question in the chat from Eric. So just to confirm, VCapital is the management company for whatever it is that you are, the companies that you're vetting out, right? So you're basically spreading it to whatever you feel is best suited for
Yep.
the okay.
Here's how this works. So there's two ways to invest. Now this is my next subject, and then I'll close. But this is the unique nature of our structure.
Okay.
We roll deals out rather than having a typical fund. We roll deals out on a deal by deal basis. So when we are convinced that we have an investment opportunity that our investors would be excited about, we form a special purpose vehicle, an LLC, strictly suited to that vehicle, and we pool our investors' money in that vehicle, and that vehicle then turns around and invests directly as one unit in the company that we're invested in. For example, one of our companies is called Intensity Therapeutics. It's a cancer drug, and it's one of my all-time favorites. It's a great drug. I know the CEO and the founder very well, Lou Bender. They just went public last year, and they are progressing towards a large acquisition, in my view. But anyway, we formed Intensity Therapeutics, excuse me, VCapital Intensity Therapeutics LLC, and that's the entity that holds that. So all of our individual investors that want to invest in Intensity Therapeutics goes into that pocket, and any other individual deal that we do. So right now we have 14 of those individual entities that we have money set aside for. In addition to that, your risk is limited, by the way, when you invest in one of those deals. Your risk is limited to that deal and that deal only. So that's the highest way of going about investing with us, is investing one company at a time. And I always counsel people. Sometimes they listen and sometimes they don't. But I always counsel people, don't invest in just one. These things are volatile, and even the best looking ones can have troubles, and they run out of money, or the market shifts, or whatever happens. But they can incur losses. That Wall Street Journal study was real. And even after doing high levels of due diligence and all the homework you can, some things can go wrong. So I caution people, don't invest in one. If you've got money to allocate to venture capital, spread it out over a couple of deals. The other way to invest, and this addresses or gives an opportunity for people who want to go with a more diversified approach. Because we've got to run our firm, and it takes operating expenses for rent, for legal expenses, accounting, for our salaries, to recruit the best team, we need operation capital. So we made the decision to sell a portion of our ownership in VCapital, the management company, to our founding investors. And you can invest directly in the operating company, kind of on the GP side as opposed to the LP side, and buy a piece of VCapital. Now, how does that work? If you invest in an individual deal, our fee structure is 2 and 20. So 2% annual management fee on your investment, plus 20%, what's called carried interest, 20% of any proceeds or profits that are incurred at the time of a sale of the company. So company sells or goes public, there's profits from that deal. 20% of those profits go back to VCapital, 80% stay with the individual investor. When that 20% carried interest comes back to VCapital, when you've bought into VCapital, the GP side, that's what you're sharing in. And investors in VCapital get exposure to all of our companies, all 14 that we're invested in now, and any deal that we do going forward for the life of the firm. So you participate in the profits of any company that has a successful exit, and you have seniority on distribution. So anytime there's an exit and those carried interest comes back to VCapital, preferred shareholders get paid first. They get their capital back, plus a preferred return of 50% of whatever they've invested prior to common shareholders. That would be me and my investment team, prior to us participating at all. So we don't get paid until you guys have your money back, plus a preferred return of 50%. And that's our way of putting our money where our mouth is, and for you taking this risk alongside us. We think it's important to pay you guys first. And then once you have that money back plus the preferred return, then we're all in the same boat. And any additional profits from that company, if there's enough from that first deal or any additional deals down the road, then we carve up any remaining profits going forward by way of investment ownership. And that depends on how much you invest. So the terms are all outlined in the back of the deck that I've showed you here. And I'm sorry for slipping through this quickly. But there's the terms are on the last page on the addendum right here. So that'll outline kind of what we're about. I can also give you just a little bit of detail here on our portfolio, just to give you a feel for maybe our top 3 deals. Like I said, there are 8 companies that are doing well, though there are 9 on here. The one company that is on here is called Padcaster. I would say it's one of the ones that they're doing okay, but they're not doing as well as the other 8. And I would say out of these 8, I would put them into 2 buckets. 4 of them look like they're going to return solid returns in the, I would say 2x to 8x range. All of these we anticipate will exit in the next 24 to 48 months, maybe 60 months on the outside. But all of them look like they're on track to have a successful exit in the next 48 to 60 months. So 4 of them are in that bucket. The other 4, Intensity Therapeutics, Ocient, EroQ, and Radiant Oximetry, are the ones we have the largest positions. And in addition to that, they're making the most progress. These are poised for much, much larger returns. From our analysis right now, it looks like they have the potential to be in the 25x or more range. And that's not untypical in a venture portfolio to have 1 or 2 companies really dominate the returns. Intensity Therapeutics, like I said, is our largest position. It's also our oldest investment. We invested first in 2016 with VCapital in Intensity. It's a cancer therapy. They just moved into phase 3 trials for sarcoma. And later this year, they'll be moving into phase 2 and 3 trials for breast cancer. They're also going global, and they'll be initiating the breast cancer trials in Switzerland. We're very, very excited about them. I would say my estimate's probably 2 years away from a big acquisition. Additionally, EroQ is a quantum computing company based in Chicago. This was started by a gentleman named Nick Farina. He approached us in 2017. We felt it was a little early at that point, not only for quantum as an investment thesis, but we felt he hadn't assembled the proper team yet. He's done that now, and the progress they've made is remarkable. They're just we invested in them as a seed company or a seed investment because we felt so strongly about the technology. Tons and tons of money is going into quantum right now, and some very big pockets are getting behind it. If you've got a cutting edge quantum strategy that can build a scalable quantum computer, you're going to control a ton of things going forward here. So we think they have a remarkable technology, and it's one of our larger positions, and they're just coming out with a Series A here in about a month. So we can keep you posted on that if that's of interest. The other one is a company. I'm sorry,
Jim. I'm sorry. So somebody just asked again in the Q&A. Can I just, instead of investing in the actual fund itself, can I invest in just one individual company?
Of course.
Since you just talked about, for example, the other 4 that are not doing as well. Yep. They're probably thinking, and Joe, I hope I'm understanding you correctly. You just rather go, go that strictly that one company you just talked about, where there's more of an opportunity of a positive return.
Yeah, well, all of them are going to be positive returns as far as we can tell now. Some are just going to be a lot larger than others. But my answer to your question is, we invested in all 8 of these companies, all 9 of these that are on your screen, at the very earliest stage, right? And several of them are now like Intensity Therapeutics. We've been in for 7 years. Ocean 3 years, Atlas 6 years. So the pricing when we got in is very, very attractive. And when you invest in the GP side, you're getting involved in those early valuations. So it's much more attractive that way. You can invest in individual deals, but you can't pick your price. You can only invest in them when they come back for a follow-on offering.
Many of you, they hear me talk or bring on other resident experts, sometimes just focus on one specific private equity deal or a one-off syndication.
Yep.
This is where the risk factor drops significantly. Now, everything's got risk, okay? But Jim and his team do a fantastic job of performing due diligence on every single one of these companies before they apply any money towards anything that they do. So and he's involved. So, every single time I say something to somebody, do not jump into any type of investment opportunity if the person that's doing this does not have any skin in the game.
Yeah. We're all personally invested in these deals as well, but we're doing okay. We're getting by, but our big payout comes after our investors get paid. And if we have big exits, we're going to make out. And that's what we're all about. But in addition to that, and I can't stress this enough, I get 2 or 3 calls a month, and I put them in touch with Lou Bender at Intensity Therapeutics. And it's, hey, Jim, my daughter just got diagnosed, and this is a real life example. My daughter just got diagnosed with sarcoma. Can Lou Bender help me? And it's like, God, I mean, the thought that we're actually doing something good, and Lou was able to direct her. He almost got her into a study at Cancer Institute in New York, and unfortunately she didn't make it. It was too far along. But those kinds of things, to know that you're involved in technologies that are really going to help people additionally is really rewarding for us. But you're right, we're all about investment returns, and all of these gray hairs are well earned.
If you guys just want to learn more, right? Network with each other, talk to each other. Look, there's nothing wrong with just starting a conversation. Okay, you go to iraclub.com. Okay, you go to VCapital. Scroll down to, where did it go? VCapital Management. Their whole focus is to help, again, diversify your retirement accounts. You guys could learn more about the company, bookmark it, the webinar that we're doing currently right now. We will add that onto here so you guys could view that later. James literally will tell you, you could contact me personally. So your time, click on that link, just talk to him. That's all we want. Learn about the actual fund. Click here to learn more. And it's going to give you a detailed breakdown and overview, okay, a description, and then leading it into minimums, returns. Those are the conversations that you have to have with Jim. The actual offerings, the pitch deck, it's all right there for you. The videos he was just talking about for just general, more information. And when you're ready, after you guys have that conversation, you could click on Pledge to the Investment and just walk through the process, or reach out to the IRA Club. You could schedule a call if you have any questions. I don't know what form to fill out next. What do I do? Am I causing a prohibited transaction? Feel free to reach out to us.
Thanks, everybody, for your time, and I hope to talk to you soon.
The information contained herein is intended to help the viewer successfully navigate common IRS and Department of Labor requirements to help achieve successful results from their IRA. The information is not intended to replace information from your legal counsel or income tax professional. IRA Club does not offer or sell any investment. All investments have risk.